Today we're looking at 5 big dividend payers in the natural resource sector. And in this video, I'm only including companies that pay big dividends today and that I think will be able to maintain or grow their dividends in the coming years. As always, don't take this as investment advice and always do lots of your own research before investing any of your money. First up, we have Birchcliff Energy trading in Toronto under the ticker BIR and over the counter in the US under the ticker BIREF. This is mostly a natural gas company. It's very, very well run, and today it has an annual dividend yield of about 7.5%, and this is assuming there's no special dividends paid this year. There was a special dividend paid last year, so it will likely be this or higher. They pay their dividend quarterly, but something big with this company, since they're so leveraged to natural gas, is that if the natural gas price goes up, their dividend could increase a whole heck of a lot. And the natural gas price in North America right now is very, very low. And when it comes to natural gas, something to keep your eye on is the price of natural gas in North America versus in Europe. Right now, as of the making of this video, the price of natural gas in North America is selling for about $1.50 per million British thermal units, whereas in Europe it's a little over $8. And you know what? It takes about $1 or $1.25 per million BTU to get the natural gas from North America to Europe. And this infrastructure to transport the natural gas from North America to Europe is currently being built. So we are going to see this gap close as companies take advantage of this arbitrage selling North American gas in Europe. That should bring the price of European gas down and the price of North American gas up, which means much higher profits for Birchcliff, and much higher profits for Birchcliff equals a significantly higher dividend. Next up is BHP. It trades under the ticker BHP on several exchanges around the world, including in the US. It currently pays a 5.27% annual yield, and that dividend is paid twice yearly. BHP is a diversified miner that produces things like copper, iron ore, and other things that are absolutely necessary for the advancement of humankind. And this company has one of the best asset portfolios around the world. And the replacement cost of this portfolio in 2024 is astronomical because these mines are getting extremely expensive to build. They're getting almost impossible to permit because you have more and more people around the world with this NIMBY or not in my backyard attitude. Everybody recognizes that we need copper and iron ore and everything else that BHP produces, but nobody wants it produced near them. And these mines are getting harder to permit. The permitting process is taking longer and longer. So why am I going into all this? Well, because of all of these things, the commodity prices are going to go up and up and up, in my opinion, over the coming years. I think this is going to be a very, very good decade in terms of commodity prices. And with BHP, higher commodity prices means higher earnings, which means more dividends. BHP's payout ratio in 2023 was 64%, which means that their dividend is pretty safe. The next dividend king is Devon Energy, trading on the New York Stock Exchange under the ticker DVN. It's currently paying a 6.6% yield, and this is mostly a gas and oil play. So a lot of the revenue is coming from gas. So like what I described with Birchcliff, as the gap between North American gas prices and European gas prices closes, that should mean a lot more income for Devon. Their dividend currently has an annual yield of 6.6%, and they pay that quarterly. So the way the company structures their dividend is they have a base dividend, which increased 10% in 2024, and then they have a variable dividend that depends on the amount of free cash flow the company has and their financing needs and things like that. But Devon has said that they're investing enough to maintain production, which is important because there's a lot of oil and gas companies out there who are not investing enough to maintain production. So if you want to take advantage of those higher oil prices and higher gas prices in the future, well, then you need to invest in a company that's investing enough to at least maintain production. And the company's policy is to return 70% of free cash flow to shareholders in the form of their base dividend, their variable dividend, but also in the form of share repurchases. In the past 3 years, Devon has repurchased about 6% of the company's shares. And this is important because it makes it easier for the company to raise their dividend in the future when there's fewer outstanding shares. Because now, every time Devon pays a dividend, they don't have to pay it to the 6% of shares, which leaves more money for the rest of the shares remaining. The next big dividend payer is Freehold Royalties. This is a Canadian oil and gas company. So like these other companies that are producing gas like Devon and Birchcliff, Freehold also is going to benefit from that closing gap between North American gas prices and European gas prices. Right now they pay a 7.4% yield, and this is the only company on this list today that pays a monthly dividend. So if you buy shares in this company, you're going to be getting a deposit into your brokerage account every single month thanks to this dividend, which is currently 9 cents Canadian per share per month, or $1.08 Canadian per year. And they're paying this with a 68% payout ratio, so I would consider this dividend safe. And also, very importantly, they're investing enough to maintain or grow production, which a lot of oil and gas companies are not doing. And because they're a royalty company, they make an upfront payment for future royalties from anything that's produced. So they're not subject to increasing costs if it costs more to drill, if it costs more to find that oil, if it costs more to extract that oil or natural gas. So the royalty business model is in general a safer business model than a producer. So that's important as well. I really like this company. By the way, I know this isn't a deep dive like I'm usually doing on this channel, but let me know if you like this style of video. And if you appreciate this video, please give it a thumbs up and subscribe to the channel. Next up is B2 Gold, trading on the New York Stock Exchange under the ticker BTG. Right now they're paying over a 6% yield, which is paid quarterly at US 4 cents per share. The company has no debt and they have a low payout ratio. So this dividend is very, very safe. And in a recent video on this channel, I analyzed this company's cash flows going forward. And this company should be making a lot more money in 2025 and a lot more money in 2026. So I think by the end of 2025, this quarterly dividend is going to be somewhere around 8 cents a share. So doubling from here. And by the end of 2026, based on my analysis of their future cash flows, I think this quarterly dividend is going to be somewhere around 12 cents per share, which would mean more than an 18% yield at today's stock price. So next, check out that video. I'll link to it right here, and I'll see you over there.